Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy and specifically what's going on with the Chinese car industry. Now, if you've been following the channel, you'll know that I've posted a number of videos talking about the car industry. And in the most recent one, we talked about the fact that despite the fact that China has 169 different brands, it's got 169 different companies making vehicles, only around 5 or 6 of them are actually turning a profit. And in this video, I want to look at some industry statistics that have come out for 2024 that show some very worrying signs. What we have got here is a huge bubble that is appearing in terms of this whole industry. All of the businesses seem to be taking on more debt, they're running more stock, they're pushing out all of their metrics, and at some point, this bubble is going to burst. So let's have a look at some of the data that's been released. And also, I want to talk about 2 companies specifically at the end of today's video that have both been listed on the New York Stock Exchange, which look like they are in serious trouble. So the first statistic that I want to look at is the average payment period over the past 6 years. And the average payment period is obviously how long a company is taking to pay all of its debts. And if you're delaying the payment of your debts, then generally speaking, that's usually because you don't have enough cash to be able to make all of the payments. And if you look at the situation back in 2019, and let's not forget that this was not long after the 2018 dip in the global economy, so things weren't going particularly well in 2019. You can see that the average payment period for Chinese car manufacturers was 98 days. And I think that's an interesting statistic in itself because generally speaking, when you're looking at the world of accountancy, 90 days is the average payment period. That's usually what a supplier will want to be paid within. And in a lot of companies, it's 60 days. So basically, you want to get paid within 2 or 3 months of actually supplying something, issuing your invoice. Because if you're the supplier, obviously, if you're waiting more than 2 or 3 months, that causes you a problem for your cash flow. And therefore, you've got to make all of your payments somehow. And the only other way of doing it would be to take on debt. So it was 98 days back in 2019. And you can see that that rose above 100 days in 2020. But 2020 and 2021 were obviously affected by the COVID-19 pandemic. By 2022, the average payment period was at 100 days. It came down in 2023, interestingly, to around 95 days. But in 2024, it's risen to 107 days. So that's the highest that the period has been at any point in the last 6 years. And what that tells us isn't that the suppliers are happy giving all of the companies longer credit, but rather the fact that Chinese automotive companies are struggling for cash and therefore they're not able to make these payments. And why this is a concern is because if you're not making the payments to your suppliers, then they are then being put under financial strain as well. Now, before we go on any further today, I want to talk to you about today's sponsor, NordVPN. Unfortunately, cybercrime is becoming an everyday occurrence. We are all at risk of somebody stealing our identity, our passwords, or our money every time we go online. But with NordVPN, you'll be protected. And the reason why you're protected is because they secure all of your data. If you go to a public Wi-Fi, for example, you log on in a store or a coffee shop or something like that, then you're potentially exposing all of your data and information to hackers. However, with NordVPN, you'll be protected. And NordVPN offers a feature called Threat Protection that blocks access to websites known to host malware, including ransomware. But in addition to protecting you, NordVPN also opens up a world of entertainment because you can access movies, TV shows, and sports events that are not available in your region. All you need to do is change your location and access all of that entertainment and information. And the great news is that Joe Blogs viewers can get an additional 4 months extra on a 2-year plan by going to nordvpn.com/Joe Blogs or clicking the link in the description below. So if we go on and have a look at the next statistic, it tells us how much stock the car industry is holding in China. And this is actually the data for the 33 biggest companies because that's all that's available at the moment. If we had more data, I would share it with you. So if we look at 2019, the total inventory that those companies was sitting on was 164 billion Chinese yuan, which in US dollar equivalent terms is around 23 billion US dollars. Now you can see that over the past 6 years, that figure has increased in every single year. And the most recent statistics for 2024 shows that it's sitting at 369 billion Chinese yuan, which is around $52 billion. So you can see that it's more than doubled over the past 5 years. And that's a concern because what that means is that the car industry is making more cars, but it's not shifting them. It's actually holding them as stock. And obviously, as a business, you don't want to do that. If you're making something, you want to sell it, turn it into cash, get the cash into your bank account so that you can then make a profit and then reinvest it into the company. If you're making things and just increasing the amount of stock that you're holding, then obviously that isn't converting it into profit. That's just turning your cash into cars, and then those cars are sitting around doing nothing. So that's a very concerning statistic, particularly as a lot of the car companies in China are focusing on electric vehicles, which is a fast growing market. There is rising demand for electric vehicles. So you would have expected the inventory levels to actually be level or going down. But as you can see, they're going up, and they're going up quite significantly. And that is a worry for a lot of those companies. Now, if we look at the inventory turnover ratio, this is the number of times that a car company is turning its stock each year. And you can see that back in 2019, it was sitting at 8.65 times. So basically, those stock levels we've just looked at, the car companies would be selling through them almost 9 times. Now, interestingly, over the last 6 years, those figures have moved around a lot. But in 2024, the inventory turnover ratio was actually above 10 times. So that's a significant increase compared with 2019. So that's interesting because the car companies are actually turning their stock 10 times per year. But as we've just seen from the previous statistic, the amount of stock has more than doubled. So they're making a lot of cars. They've expanded rapidly. They're turning the stock up very quickly. However, the total stock is rising. And what we are hearing from China is that a lot of the car dealerships are being forced to take these vehicles. So they're being told by companies like BYD and Geely that you have to take another delivery of cars, even though they may not have shifted the previous cars that they were looking to sell. So what the car industry is doing, it's turning a lot of cars, it's making cars, it's pushing them out, but it's pushing them out to these dealerships who are then being left with a glut of vehicles. And what's happening is we're having to see price wars and slashing of prices to try to persuade consumers to buy those vehicles. So ideally, what you would like to see when you've got an inventory going up like this, when you've got a ratio that's rising, they're shifting more stock, would be that the stock levels should be going down. But actually, as you can see, the stock levels are going up. So basically, the car manufacturers are making lots of vehicles. Some of them are going to stock, some of them are going to the dealerships. Not all of them are being purchased by consumers, and that's part of the problem. Now, in terms of total debt, this shows the situation over the last 6 years, and you can see that in 2019, the total debt amongst the 33 companies that were provided this data was 616 billion Chinese yuan. That's increased in virtually every single year. And the most recent data for 2024 shows that the total is now sitting at 959 billion Chinese yuan, so just short of a trillion. And that represents a 50% increase over the past 6 years. And clearly, what we've got here is an increase in stock and an increase in debt, not an increase in sales and profitability, which is what you would really want to see. And clearly, when you've got increasing debt, that increases the risk because you have to service that debt. You have to pay interest on that debt. So that increased the cost of your business. You're having to make those monthly payments on the debt. And ideally, you should be repaying that debt. But as you can see, the car companies are not repaying the debt, they're just increasing it. So what that indicates is that they may be using debt to cover their losses. What you should be doing is making a profit and then banking that profit and building up a cash reserve rather than what is happening is that they're building up a debt problem. And that debt problem is because a lot of these companies are funding losses. They're not making a profit. And so the only other way to survive is to borrow more money. And if we look at the split between debt and equity, so this tells us how much debt a company has on its balance sheet compared to its equity, so the money that it's raised from investors and also any surplus profits. And back in 2019, the debt equity ratio in the car industry in China was 30.25%. So that represents 30% leverage. If we now look, and you can see that over the last 6 years, that has worsened significantly. And the most recent data for 2024 shows that the debt equity ratio is now 51.29%. So the majority of the capital on companies' balance sheets is now debt. It's gone past the 50% point. And what that tells us is that these companies are not making profits. They are not building up a nice amount of equity. They're not becoming more valuable because they're making profit and turning it into cash and sticking it on the balance sheet. What they're doing is borrowing more and more money. So they're becoming highly leveraged. And the problem that you have is that they may get to the point where they can't afford to service that debt. They don't have enough money to actually make the interest payments or the repayments that are due. And then you become insolvent and bankrupt and have to close the company down. So these increasing debt to equity ratios represent signs of strain and increased risk in the industry in China. Now, I wanted to have a look at the key metrics for BYD, which is by far the biggest car company in China. And BYD does make electric vehicles. It's the biggest electric vehicle manufacturer in the world now. It's overtaken Tesla, but it also makes hybrids. So it's not just battery only electrics. They'll do some hybrids that involve, some combustion engine parts as well. And if we look at what's been happening with BYD over the last 6 years, start off by looking at their average payment days. In 2019, their average payment days were 81 days. So that was less than the 90 days that we talked about earlier, making your payments within 3 months. However, as you can see, over the last 5 years, those payment days have increased in virtually every year. And by 2024, the average payment days are now sitting at 127 days. So that is a lot. That's more than 4 months that they're taking to make payments to their suppliers. And if we jump back to the original chart, you can see that the average for the industry in China is 107 days. So BYD, despite being the market leader and the front runner in this game, they're actually at the bottom end in terms of when they're making their payments. And that's a major problem because as the biggest manufacturer, they will have lots of relationships with all of the different car manufacturing suppliers in China, and they're not being paid. So the only other option for those companies, if they're not being paid, is to take on more debt. So that's one of the reasons why the debt to equity ratio is going up. Now, if we look at the net margins, BYD, I think, stands out as different to the other car manufacturers because they're actually making a profit. So in 2019, that profit was 1.7%, and it's increased over the past 6 years, and the current level is about 5.4%. Now, that was in 2024. However, BYD has embarked on an aggressive price slashing campaign recently. So I would imagine that those net margins have come down materially. Now, if we look at the total amount of stock that BYD is sitting on, back in 2019, it was just under 26 billion Chinese yuan. But that number's increased in every single year since then. And the most recent data for 2024 shows that it's now sitting at 116 billion Chinese yuan. So that's more than 5 times increase over the past 6 years. And the reason why they've got so much inventory is because they're not selling all of the cars. They're making lots of cars. They're rapidly producing lots. But the level that they're selling isn't moving at the same pace as they're making them. And so they're having to put some in stock. And in terms of the total amount of debt that BYD has, in 2019, it was sitting on 90 billion Chinese yuan. That's increased significantly over the past 6 years. And the most recent data shows that it's sitting at 194 billion. So debt has more than doubled in the biggest car manufacturer in China over that period. Now, I wanted to talk about 2 companies that are listed on the New York Stock Exchange. And the first of them is a startup company from 2014 called NIO, which you may or may not be familiar with. It makes cars, predominantly electric cars, and not many of them are sold overseas. In fact, I'm not sure any of them are sold in the USA, but bizarrely, it was listed on the New York Stock Exchange in 2018 as part of an IPO. Now, that IPO didn't go particularly well. And as you can see from this table, in 2020, the company almost went bankrupt. Now, obviously, that was part of the COVID pandemic, but it wasn't well capitalized, it wasn't making sales, and it was rescued by a $1 billion investment from one of the municipal governments in China, which allowed a restructuring and an expansion. And since that time, it's been expanding rapidly, and it's got this innovative battery as a service model. So you may have heard of SaaS, which is sales, the whole internet explosion, where you're doing SaaS models, and these are the companies that can become hugely profitable and valuable. But NIO is known for having BaaS and basically allowing people to swap batteries out of their cars. So quite innovative. And in 2024, the company delivered 220,000 vehicles globally and surpassed 750,000 by mid-2025. So it's growing rapidly. Let's have a look at some of the statistics for NIO. So if we look at their average payment days, you can see that in 2019, it was at 165 days. That's off the scale compared to what we just looked at. We were talking about 107 average for China and 127 for BYD. 165 back in 2019 is dreadful. However, it's got worse than that. And in 2024, it's now paying its suppliers on average in 223 days. So that is more than 6 months. It's more than 7 months. It's eight months. So if you're supplying parts to NIO, you're not going to get paid for 8 months. No business can manage those sorts of payment levels. It's just an absolute nightmare. So this is a big problem because, as we just saw, that company is selling lots of cars, 750,000 by the middle of 2025, but it's not paying any of its suppliers, certainly not for the next 8 months or so. And in terms of the profitability of NIO, well, back in 2019, which was the time when it almost went bankrupt, its net margin was minus 144%. So that's pretty bad in anybody's book. And you can see that in every single one of the past 6 years, it's been making losses. And in 2024, those losses equated to 34% of revenue, which is just a nightmare. So basically, for every car you make, you're losing 34% of the cost of that car. So how can that continue? How can you continue making 750,000 vehicles when you're making these sort of losses over this prolonged period of time? And let's not forget, this company is listed on the New York Stock Exchange. Now, clearly, it will need to fund that from some other source. And that other source is debt, but we'll come on to talk about that in a second. Now, in terms of total inventory, how much stock is the company sitting on? Well, back in 2018, it was sitting on just under 1 billion vehicles. Now it's sitting on over 7 billion. Sorry, these are Chinese yuan. So it's increased 8 or 9 times over the last 6 years, the amount of stock that the company is sitting on. So it's making lots of cars, but a lot of them are going into inventory. And in terms of how it's funding all of this, well, you can see that back in 2019, it had 8 billion of Chinese yuan debt. It's now got over 20 billion. So the debt has increased 2.5 times. And when you're making losses of 34%, how can you service that debt? It's just not possible. So this company is not looking in good financial shape. It is basically illiquid, bankrupt. As soon as somebody steps in, you would close the whole thing down. And the other company I wanted to look at was XPENG Motors, which is also listed on the New York Stock Exchange. It was listed in 2020 in a $1.5 billion IPO. Now, this company was also founded in 2014, and it focuses on intelligent EVs with advanced autonomous driving features, targeting a younger tech-savvy market. In 2022, the company expanded its range, producing a sedan and an SUV, and its focus is aggressively pursuing in-house software for autonomous driving and intelligent cockpit features. Now, not sure about you, but I don't think about my car having a cockpit, but the XPENG Motors do. Maybe they're going to develop some wings later. And in 2024, the the company delivered 190,000 vehicles and is steadily growing. Now, if we look at the statistics for XPENG, average payment days back in 2019, 79 days. That's pretty decent compared to a lot of the statistics we've looked at in today's video, just under 3 months. However, by 2020, that had increased to more than 7 months. And by 2024, we're looking at a similar figure to what we just looked at for NEO. So just to put that into perspective, 6 months would be 180 days. So we've got basically 8-9 months that this company is waiting before it pays any of its invoices. Absolutely outrageous. That's not the sort of company that I would like to deal with if I was a supplier. Net margin back in 2019, minus 159%. Well, it was relatively young at that time. And it's improved over the last 6 years. But in 2024, still banking a 14% loss on all of its production. So somebody has to fund that because it's not making any profit. In terms of total stock, back in 2019, there's about 500 million of Chinese yuan sitting in stock. 2024, that had increased to 5.5 billion. So that represents more than a 10 times increase over the last 6 years. And the total debt, back in 2019, it was at 2 billion yuan. It's now sitting at 22 billion, which obviously 10 times increase. So once again here, the reason I wanted to show these statistics is just to show that this company isn't actually financially viable. It's not turning a profit. It's not actually able to service this increasing amount of debt. Somebody is funding the company. It's the banks at the moment. And essentially what we've got here are two examples of car businesses in China that are growing, but the only reason they're growing is because they're given more and more debt. And this is a very similar story to what we talked about in the property sector. We've talked a lot about what's happened in the Chinese property market, whereby a lot of developers came in, they were attracted into a growth market, they were all given lots of debt, they all grew rapidly, they made lots of sales, they didn't make lots of profit, and then eventually when the debt was pulled, a lot of them went bankrupt. And what we're seeing here in the car industry is a very similar situation. So what's the summary and conclusion today? Well, I wanted to post this video because we've been looking at the Chinese car industry for a little while now, and what we are seeing as we've lifted the bonnet to have a look at what's going on underneath, we're seeing some very worrying signs. What we have got is a market that is oversupplied. 169 different brands is too many probably for the whole of the world, never mind the Chinese market. And most of those 169 brands are predominantly selling into China as it stands. Some of them have gone global, like BYD. They're on a very aggressive expansion program at the moment. But the majority of them are just looking to the Chinese market. So we've got a huge glut of brands. Now we've got a growing market. So in theory, all of those brands could find a position. But in reality, what we are seeing is a very aggressive price war. So BYD, as the market leader, is making more and more vehicles, taking on more and more debt. We saw the statistics earlier, holding more inventory. So it's slashing its prices because it can afford to. It's one of the only companies that's making a profit. And you can now buy a BYD for less than $10,000, which is pretty cheap for an electric vehicle. Well, you can't really in America because obviously there's a 100% tariff, and now we've got other tariffs on top of that from Donald Trump. So it would be a lot more expensive than that. But if BYD was able to just sell with no tariffs, that's the price you'd be looking at if you were going to a dealership to pick up one of these vehicles. But the problem that's now causing for all of these other 168 businesses in China is that BYD is undercutting the market. It's offering very cheap vehicles, and they're not making any profit already. They were already banking losses. But if they're now having to enter a price war and cut their sales price, then those losses are going to increase. And the only way that these businesses have been surviving is through taking on more and more debt. And as we've seen in today's statistics, what that means is that as the losses have increased and the debt has gone up, they've delayed paying their suppliers. So the average payment days is now over 100 for all of these companies. But actually, as we saw from the specific details on NEO and XPENG, they're now waiting 8 or 9 months before making payments. Now, that tells you that this whole industry is on its knees, because if you're a supplier and you're not being paid for 9 months, then the only way to survive is to take on more debt. So these companies and the dynamics of the market are forcing all these companies to actually take on more leverage to expose their risk. That means they're all paying more interest, which is putting more strain on their budgets and their finances at a time when they're already making losses. So this is just losses on losses. And at some point, there has to be a shakeout of this market. You can't go on having 169 brands and most of them making losses and then introduce a price war. And then on top of that, introduce tariffs around the rest of the world, which is what the Chinese car manufacturers have seen. It's not just the USA, Europe, and lots of other countries have imposed tariffs directly on Chinese electric vehicles. So this industry is under attack, both from the external force of tariffs and also internally from price wars. And I think what we will see over the next 6 to 9 to 12 to 18 months is that many of these Chinese car companies will be proven to be not viable. They'll be illiquid. They may be made bankrupt unless the Chinese state continues to allow the banks to give them an endless amount of credit, which is what's been happening over the past 6 years. We've seen the data in today's video. If that happens, then obviously they will survive because they're just being fed more and more debt. But I think realistically, what will happen is what we saw in the property market, where at some point the authorities say enough is enough, you can't have any more debt. And that would mean that most of these businesses would be put out of business immediately because they simply can't survive. They're not making any profit. They don't have any cash. They've got huge amounts of debt. They can't repay that debt. So at some point, there will be a huge shakeout, and we may well be left with 5 or 10 brands in China, but certainly nowhere near 169. So the overall summary of today's video is that the Chinese car market looks doomed when you look at the volume supply, the demand, and the levels of profitability and debt. It all looks really seriously bad news for those businesses. And over the next few years, it's likely that we will see the number of car manufacturers in China reduce significantly. So hopefully you've enjoyed today's video, you found it useful, informative, and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and thanks so much to everyone that supported me, either through YouTube Super Thanks, or Buy Me a Coffee, or YouTube membership, Patreon, or Buy Me a Coffee membership. Really helps me to stay motivated, so thank you so much for that, and here's something to put a smile on your face.
Don't do it. No. No. Don't do it. No. No.